Good afternoon, everybody. First of all, I want to thank you, the World Bank, and especially the AgriFin team for putting together this wonderful seminar, and of course for inviting us to participate in this. Thank you very much. Let me start by talking a little bit about Agrofinanzas, which is right now Agrofinanzas Bank. We started as a non-deposit taking financial institution back in 2004. And from that, we have grown a little bit. I'm going to show some numbers right now, but last December, we got the banking license from the Mexican financial authorities, which for a non-deposit taking institution in Mexico is a big challenge. The Mexican financial system is a very concentrated system. More or less 90% of the financial assets are held by 5 to 6 financial institutions. And if you consider that these banks are the largest banks in the world, including Citibank, BBA, Santander, HSBC, Scotiabank, competition is not easy, as in many other markets. So back in 2006 and 2007, when we started developing our financial and business model, we decided to target this market mainly because there is a lack of financing in this sector, as you are all aware of. And it so happens in many countries, as we've been hearing of right now. But we do believe that this market, the agribusiness sector, poses a big opportunity for all of us, not only in Mexico, but in many different countries. And as you are all aware of, food production and clean energy production either are directly linked to the agribusiness sector. And we are firmly believers that this is the right path to go and the right way to go in order to include in the financial system so many people that in the past have been rejected from other financial institutions. We as a bank, right now as a bank, are planning to launch different products and different initiatives to include these people in the formal financial system. But let me start with our current business model. As you all know, small farmers have traditionally been credit constrained. This is due to the fact of many different reasons. Here are just listed what we think are the most important ones. And hearing from all the presentations in the seminar, we think that we find these same problems to tackle in many different countries. There is asymmetric information. A lot of these farmers, of course, don't have any formal financial statements. Many times they don't pay taxes. They are in the informal sector. And many times you happen to find that you don't have any formal credit history to look up and to watch and to see if they are credit-worthy enough or not. Of course, they are perceived as higher risk, mainly because the low scale of production. That's one of the reasons that a lot of different banks and financial institutions decide not to participate in this market. In Mexico, at least, many different commercial banks have taken very active decisions to not finance the agribusiness sector. When you go and speak to them, they very decisively tell you that they are not going to finance the agribusiness sector, mainly because it's a very high risk sector. So other factors are the low capital endowment that these farmers currently have. Of course, lack of collateral. Many times they don't have any collateral to put but the land. But if you take into account that more than 50% of the current ownership of land in Mexico is under communal basis, that means that they cannot put a mortgage on that land because the community is the formal owner of that piece of land. And if you add that even though you face a farmer that actually owns on a small property on a private basis his or her own land, it's very difficult to execute mainly because of court delays and a lot of different issues regarding the legal processes, but also even if you are able to secure that land as a collateral and the client defaults, what are you going to do with that piece of land if you are a commercial bank or a financial institution? So this is another very important issue to tackle. High transaction costs in serving them, of course. These farmers are located many times in very farther away communities, which, of course, they don't happen to find any banking branch or any financial institution in those communities. And of course, the cost of origination and monitoring the loan portfolio can be costly prohibited, and many times banks decide not to enter into those markets because of those reasons. Of course, concerns on commercial viability. If you are very small, if you don't have any collateral, if you are lacking capital endowment, how are you going to increase your commercial capacity? But this is probably one of the main lessons we learned throughout this process, is that even though these factors are a reality in this market, you happen to find a lot of different processors, traders, large companies that have been forced throughout the years to finance these farmers to secure commodity origination. This is a very important piece of the business model, mainly because these companies are financing these farmers to secure the commodity and quality of the origination. This is very important to stress because you find wheat mills, sugarcane mills, corn processors, corn traders, cotton traders, that financing is not a core business, a core operation in their business, but they end up doing that activity in order to secure its product. So this is a very important piece of the equation. We have developed an innovative business model to serve these small farmers. First of all, we make a partnership with these anchor companies, the processors, the traders, the mills. We establish with them a profit and loss sharing agreement. This is very important to actually balance all the risks that are involved in the process, and we want to make sure that we are partners in the process, because otherwise it will be very easy for these companies to step aside and say, okay, if Agrofinanzas is willing to put money into the system, is willing to finance these small farmers, okay, do that, it's your money. But we establish a profit and loss sharing agreement to be sure that they put some skin in the game. This is very important, and this is key in the process as well. With this model, what we've been able to achieve is to transform all the fixed costs that any financial institution faces, financing or servicing these very farther away clients, transform these fixed costs into variable ones. with these agreements, we don't set up banking branches. We just partner with these companies that have already made substantial financial investments in infrastructure to actually do a different type of business, but they are already in the ground, they are in the field. So we are taking advantage of that, and we are partnering with them. We have been able to industrialize the process. We've made substantial IT investments in order to be able to process a very large amount of loans in a very secure and efficient fashion. And also, not only right now because we are a bank, but back in the past, the past few years that we've been developing this model, we've been applying banking standards, we've been complying with the banking regulation, establishing credit files for these clients, the KYC rules, the IFRS rules, and Basel II, and now Basel III rules. This is a graph that we like very much, mainly because I think it summarizes the key process. You find in the market thousands, literally thousands of raw material producers. They could be sugarcane growers, cotton growers, corn growers, wheat growers, any type of grower. But then, in the supply chain, what you find is hundreds or many times tens of companies that buy this production. So these companies are the key targets for the model. We partner with them, and we establish this banking relationship with them. This is very important to emphasize that we are financing on an individual basis all these raw material producers. We are not financing the off-taker company. We are not financing the sugar mill or the wheat mill. We are financing the individuals. We are making and establishing banking relationship on an individual basis with these producers, but using the existing infrastructure of these companies. And this type of cone works also the other way around. In some other distribution chain models, what you find is exactly the same thing, but going the other way. For instance, you happen to find a very large fertilizing company that actually distributes its fertilizer and agrochemicals through a very large amount of different suppliers. And you can actually build the same exact relationship. And also you find this, for instance, in the machinery and equipment distribution chain. You happen to find an anchor company, for instance, John Deere or Caterpillar, and you can actually partner with them to distribute their machinery. The business model we've been able to develop solves many of the issues regarding financing these small farmers. The asymmetric information problem is solved mainly because we use the database of these off-takers to actually analyze the past performance and assess cash flows of these small farmers. It is mandatory in the model that these farmers actually have a long-term agreement with these off-takers, and not only that, but the off-taker is obligated in the agreement to buy the production from the farmers. It's pretty much like a forward agreement of these farmers to sell their production to the anchor company. So what we are doing is actually just financing that forward agreement, and we are basing the most important part of the credit analysis on the capacity of the anchor company to actually finance, to actually pay for the crop, sorry. So this is a very important part of the model. The risk, the higher risk and the low scale is tackled by using the processor as an off-taker and guarantor of a first loss of the portfolio, pretty much as a junior tranche in the portfolio system. it's very important to mention that these anchor companies were already financing their suppliers. So the deal that we propose to them is actually to reduce its exposure because they needed to leverage its balance sheet in order to be able to finance these suppliers. Instead of doing that, we are putting the money into the market, but they need to secure a first loss guarantee. This percentage runs from the lowest for 5% to the highest one to 40%. It depends on the specific of the crops, the risk that we are running, and the ability and the capacity of the company, the financial strength of the anchor company. The lack of collateral is tackled just using future cash flows as collateral. For these small farmers, we don't take any type of collateral but the future crop. That's it. We don't secure land in a mortgage or any type. We don't secure equipment. We don't secure anything. We only take future cash flow as collateral, which is the future value of the crop. And the anchor company retains payment, and this is very important. Collection of this portfolio is done at the very same time when the production is delivered to the off-taker. So this is very important also to emphasize because we are not imposing on the off-taker any duty or any activity that he is not willing to perform. This is a very natural way to collect the loans, but we don't have loan collectors on the field. The farmer goes and delivers the crop, and in that very same moment, the loan is collected. High transaction costs are tackled, as I mentioned, outsourcing logistics. The anchor company helps us in obtaining all the proper documentation, field supervision, distribution of money, and collection. This is very important also to emphasize. Once again, we are not imposing any that they are not willing to do for their own sake, for their own good. Field supervision, as you are all aware, is very important. In the past few sessions, we have a lot of questions regarding how do you properly assure that the funds are properly used? How do you secure that the farmer is going to use the funds to actually farm into the land and to use them to buy all the inputs to grow its crop? Well, the anchor company is already in the field, and they are willing to do that for their own sake, for their own good. And they do it for us, and we just supervise that activity by a sampling. We do a statistical sampling of all the loans that we disburse, and we go and check that they are actually doing their job. But it is very important to emphasize that they do their job not because of the off-taker agreement that they sign with us, not because they care about our loans. Of course, they don't care about our money. They care about their future commodity. If they don't supervise the farmers, they will end up with no commodity. We could not know anything about wheat flour production or sugar cane production or sugar production, but it's very easy to understand that a sugar cane mill without sugar cane cannot do anything. So this is key in the process. We are financing a key commodity for these off-takers, and they pretty much value this operation for that reason. The model works in the following way. This is a very simple example. Let's assume that we have a wheat mill that provides working capital and buys raw wheat from 200 producers. Let's assume that this wheat mill has an equity of $10 million US, liability for 15, and assets for $25 million US, out of which $8 million US are accounts receivables from these producers. So, as you can imagine, you can do the math very quickly, 40% of the whole assets of this company are put into the field just to finance these suppliers. But this is not key for the company. This is not what they are meant to do. But they end up financing these suppliers because they need to. So what we do is we propose this agreement. We go and finance on an individual basis these producers. The average loan could go for $40,000 US. Every loan has a crop insurance embedded. It's mandatory. With meal, of course, the leverages its balance sheet. And assuming, for instance, for example, which is a typical percentage, a 20% first loss guarantee, i.e. 1.6 million US, instead of running $8 million US credit risk, they are just running 1.6. But not only that, but they write that down off balance. They are not putting that into their balance sheet. Agrofinanzas is doing that. And most important, they keep control of the money supply and retain payment from the producer at crop delivery. The wheat mill, this is very important, receives a 20% commission calculated on the net financial margin out of reserves obtained at the end of the cycle on the finance portfolio. We don't pay anybody to bring us loans. We only pay the commission once the crop cycle has ended, all the loans have been repaid, and then we deduct any reserves that we need to make on that loan portfolio from the commission we pay to the off-taker. But in this sense, as I mentioned, this is a true risk-sharing model. Individual producers, on the other hand, develop a credit history in the banking system, preserving a one-stop solution. The wheat mill buys the crop and facilitates financing. And not only that, but we got a diversified credit portfolio of 200 clients worth $8 million US. The model has proven successful. That's the history of this model. The loan book is very well diversified. We are financing from cereals, corn, wheat, sugar cane, shrimp aquaculture, wheat, alfalfa, cotton, cattle, livestock. It's a very well diversified portfolio based in the same simple principle. Agrofinanzas has more than 23,000 active loans right now, and this is very important to emphasize. The average size loan is only $3,400 US. By many standards, these loans are pretty much like a microfinance institution, but the interest rates much more lower than a microfinance institution. The interest spread is on average 770 basis points above the risk-free interest rate, which in Mexico is somewhere around 4%. So we end up financing these small farmers on an interest rate which is 13%, 14% on an annual basis. The cheapest credit card interest rate that you can find in Mexico is 25%. And if you talk about microfinance institutions and even these large banks that have become, that have developed their business model from the microfinance area, they are charging currently 100% interest rate or more on their clients. We are only charging a fifth of that. The NPLs ratio is 2%, much lower than consumer lending and microcredit in Mexico. And more than 80% of our current clients had no formal credit history. How do we know that? Because we check on an individual basis the credit bureau. And Agrofinanzas has been their port of entry to the financial system. The retention rate is more than 90%. If you do this successfully, you manage to have the same loan portfolio cycle by cycle once again. The model creates value to all stakeholders. Processors, traders establish a supply chain financing facility off balance sheet. Leverage and credit risk are reduced for processors and traders. Farmers have access to formal credit, and right now they are developing a credit history, and not only that, but they have been able to get from Agrofinanzas capital expenditure loans. Right now, we are financing for these same farmers irrigation system and other long-term investments that these anchor companies will will not finance to these farmers, mainly because they are not interested in doing that. What's the purpose of a wheat mill of entering into a long-term agreement to finance a tractor or to finance an irrigation system to these farmers? But we are doing that. Farmers maintain the one-stop shopping facility. We have a very profitable model solving information, credit, and transaction cost problems. This is a very efficient model. Agrofinanzas headcount is only 40, and we manage this loan book with only 40 people. Reorigination process is streamlined. Portfolios become perpetuities, mainly because if you partner with the right companies, they are going to be needing the commodity year after year. Finally, we believe that we have a very strong, solid position to continue our road. We are regulated by the Mexican financial authorities. That's the composition of our shareholding. So far, main funding has come from government-owned bank, but we are diversifying, and right now, mainly because we are a bank, we've been able to reduce our funding cost by 200 basis points or more. Capital adequacy ratio is higher than 28% by Basel II Accord agreements, so it's a very high capital adequacy ratio, which you can imagine it also keep rooms to keep on growing the portfolio. We have been able to issue short-term commercial paper in the Mexican Stock Exchange. Agrofinanzas is seen by investors as a fixed income ETF that invests in Mexican agriculture, offering asset for diversification. And as I mentioned previously, we have obtained the banking license to operate in Mexico. This will enable us to expand our business model into other economic sectors, strengthening our funding capacity. We are very excited about the moment that Agrofinanzas is currently living right now, and we are very happy to share this experience with you. Thank you very much.